Good morning. Welcome to Stock Market Today. It's Thursday, June 4th, 2020. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. Follow along with the content from this show. Get daily stock ideas to consider. Hits your inbox every trading day before the market opens. So, U.S. equities were higher once again in Wednesday's trading, finishing near the best levels of the day. Cyclical/value outperformed once again as the Russell 2000 and the Dow led the charge higher. Treasuries were weaker with the curve steepening. The dollar was stronger against the yen, but weaker on euro and sterling, a continuation of some trends we've seen over the past couple of weeks. Gold was down 1.7%. WTI crude was up 1.3% in choppy trading. As we get to the desk this morning, however, futures are down about 50 basis points to start the day. That was on the heels of Asian markets being mostly higher overnight, but European markets trading lower this morning. Treasuries are stronger following recent weakness, especially at the back end of the curve. Dollar stronger versus the euro and sterling. Little change on the yen cross. Gold up 40 bips. WTI crude is down nearly 2%. Here's your S&P 500. It hit our level. Closed above it yesterday, but we've been highlighting 3110 for a while now. We've really been laying out a solid roadmap since about here, right? When the market rebounded from here, we said the initial low was likely in, and you needed to start thinking about 2800, right? Then we had a little bit of a pullback and then this big gap higher. And then on April 7th, we wrote that the strength from the previous day opened the door to 2,800 to 2,900, which we subsequently tagged, right? Then we started laying out the next roadmap with 2,930 to 3,000, opening the door to 3,110. So following our roadmap pretty much to a T. Notice how that's not calling a bottom, calling a top. It's using data points and triangulation and coming up with odds and probabilities of where the market could go. And then when it goes there, reassessing, all the while managing risk. It's not about a crystal ball. It's not about calling the top and calling the bottom. I have yet to find somebody who calls tops and bottoms with any kind of regularity, right? And I don't even try. My goal is to give you a roadmap and a framework in which to operate, and then drill down from that roadmap to find the best opportunities in the market. Right now, I think resistance is 3150, and then the February high. Should we hold here, right? If we do get a pullback, you have to start thinking about 2950 to 3000 as initial support. Obviously, 3000 is important. 2950 is this consolidation right here. Below that, 2850, where this gap opened, and where the 50-day moving average is rapidly approaching. You notice that we're moving up the support level, right? This is how it plays out. You watch the key levels. We're overbought in the near term based on the 13-period CCI and the 3-day moving average of that. But Chaikin money flow has swung to a bullish side a little more strongly of late. I think here, I wouldn't be surprised to see some churning in the market. We actually are at a key Fibonacci level. And given the overly bullish sentiment that I highlighted yesterday, as well as the fact that we're overbought based on our indicators, certainly wouldn't be surprised to see some churning here, maybe some backing and filling. The key would be for these near-term support levels to hold. So that's the roadmap as of today. What are we talking about today? Stocks grind higher, led by small caps and the Dow. Major market ETFs are now overbought, right? Sentiment is bad, right? We talked about a lot of this stuff yesterday, and we're going to look at breadth today. Okay, futures do point to a lower open here this morning, and I just realized that I have a little bit of a system malfunction as this slide did not update. I apologize for that, but let's run forward. For the Dow, we were up 2% yesterday, 5-5 bulls to bears. S&P 500 up 1.3%, 111 bulls, 80 bears there. You're starting to see these swing to the bullish side now, right? Dow is even. NASDAQ 36 to 6 after underperforming yesterday. NASDAQ underperformance is something that I've been watching. My initial view is that it's temporary in nature. Small caps outperform once again, 639 and 248 bulls to bears. Bonds downtick, sending yields higher. Here's your cyclical trade with industrials up nearly 4% on the day. According to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Major markets are mixed. As promised, every Thursday, rather than a stock of the day, I always said I would bring you stocks of the day, or a screen that I think makes the most sense for the current market environment. And today's screen is what we call classic bears. Great classic bears are stocks that are bearish or very bearish, that are below a long-term trend line with weak money flow as well as weak relative strength. So with that in mind, especially with the market overbought, with sentiment overly frothy, with the S&P 500 having kind of hit our level and is now reaching a key retracement level, I want to highlight names that I think could be sources of funds if you own them. Highlight names that could provide bearish opportunity should we begin to stall out and move higher from current levels. So it's a really quick screen to take the Russell 3000 down to about 34 names that look compelling. Now, the ratings are as of yesterday in the screener, but you can see some names there that may be, have had nice runs and might make sense to take some off the table. American Airlines, Boeing jump to mind. Roku is an interesting name in there. Just a little something to give you here. You can go back and watch this, take a screenshot of this screen, but this to me are names that could be sources of funds or bearish opportunities here in the near term. Let's hit our sector tracker now. Movement of the major sectors over the last 5 days. Utilities top of the list. I talked about that being interesting yesterday. Materials, your cyclical rotation. Remember 2 weeks ago, we started highlighting materials. We started talking about the fact that if this rotation was real, materials were where we wanted to gain exposure to it first. Based on our process, materials is the only cyclical group of the 4 major cyclical groups that does not have a bearish rating. REITs, a little bit of a rebound trade there. Energy, cyclical rotation. Industrial, cyclical rotation. Financial, cyclical rotation. You get the theme. Discretionary tech at the middle of the road. Staples, healthcare, comms, bottom of the list. All groups higher over the last 5 days is interesting. But to me, I'm just kind of triangulating data points here. I see a market that's overbought. I see overly bullish sentiment. I see the S&P 500 tagging or getting close to a key retracement level, and I see utilities outperforming. Right? I'm not saying sell everything, go to cash. I'm saying stick with your best names, but it's a logical place to see some stalling out, to maybe see some backing and filling. If there are cheap hedges to be had out there because of the run that the market has had, they might be worth exploring. Right? It's interesting to me. As always, manage risk. Our industry in focus, healthcare services, has been a outperformer over the past 6 months by about 6.5% and has a strong power bar ratio, 19 to 9 bulls to bears. Currently ranked number 13 of 21 subsectors, having moved down 5 slots over the past week. Top names in this group: Vivo, Meridian Biosciences, ICU Medical, ICUI, and Integer Holdings, ITGR, all with very bullish ratings for an area of the market that's been leadership, remains leadership here in the past few months, has a bullish ETF rating. There's that ratio, strong trend above the rising long-term trend line. The only issue here is we're overbought in the near term. Solidly bullish money flow, outperforming, bullish rating, type of name you want to look at. If it's a stock, type of ETF you may want to consider as within an ETF portfolio, or drill down on these 19 bullish names and see if there are any that's set up currently. My guess is overbought conditions are going to be prevailing. Market's overbought and its strongest sectors are overbought as well. Let's take a look at what's trending now. Yesterday's S&P 500 movers and shakers, gainers and losers. SPG initiated a buy today. Didn't see any news there. Simon Property Group up 15%. BA Well, there was some news around the 737 MAX that sent that stock higher by about 13%. IATA data sent United Airlines higher by 12.5%. Microchip raised their guidance. That stock higher by 12%. HBI was up with the apparel vendors. On the loser side of the board, Campbell earnings, stock lower. Nothing company specific. Activision and Take-Two, two bullish gaming stocks that have been running of late. Some profit taking there. Tyson down as the management team at Pilgrim's Pride was implicated in a price fixing scandal. May have some implications for the broader chicken market. Newmont Mining down with gold on the day. Let's dive into the charts now. Breadth continues to improve. Percentage of stocks in the S&P 500 above their 200-day moving average, now back above 50%. That is interesting. Now, there are now a majority of names in the index above their long-term trend lines, and that's important, right? That is important to the bigger picture trend. That tells me that if we're able to sustain that, if we did get a pullback here, I'd look for support levels to hold. How about the intermediate term? Absolute monster. I went back 20 years. I have not seen the percentage of stocks above their 50-day moving average higher than they are right now. 97% of the stocks in the S&P 500 are above their 50-day moving average. 20-year highs. You can make the case that that's a little bit overdone in the near term, especially if you kind of triangulate it with other data points and kind of build that matrix, and connect the dots. The advanced decline line has kind of shaken off a near-term divergence and has begun to move higher again as well. So breadth continuing to improve here. What I will say is if I look at the percentage of stocks at Chaikin Analytics with bullish or very bullish ratings, it's back towards its long-term average after being severely depressed. So breadth improving, that's what you want to see. We're not seeing the types of divergences that are overly concerning just yet. I think for me, markets kind of hit an area where we could see some stalling out, and then we'll watch to see how everything else plays out. But breadth improving as markets rotate is something we've been saying we want to see. We're starting to see it. And that's how you drive the roadmap for folks. You connect the dots, you look at the data points to assess the odds of what's likely to happen. And then when it does happen, you reassess. And if it doesn't happen, well, you have a risk management framework to keep you from blowing up. And that's how we did it from basically March 25th to now. That's how we built our roadmap. Here's what's likely to happen. When it happens, you reassess. Here's what's likely to happen now. When it happens, you reassess. Here's what's likely to happen now, and it's happened. We're at the 311 mark. I've reassessed. I think we're a little overdone here in the near term. Overbought, excessive bullishness, key retracement levels, near-term excessiveness in breadth, 20-day moving average also above 95% as well, percentage of stocks above their 20-day. So that's how I'm kind of framing it up. And if that environment has produced cheap hedges, might not be a bad idea to look at them. I was told there was a value rotation. It's interesting to me is that while value has rallied, it's not above its 200-day. This is the VOOV, Vanguard S&P 500 Value ETF, right? Still hasn't taken out that level that SPY has. And look at the scooter for VOOV, right? Relative performance. Not that compelling, right? Not that compelling at all on a relative basis, right? So while we have seen some rotation into more cyclical / value areas in the market, I haven't seen enough yet that would get me to come off my theme of favoring growth. I just wanted to kind of point that out. And that is going to wrap us up for today. Head over to chaikinanalytics.com/test drive to take us for a free 14-day trial. I am going to be back here with you tomorrow.